Hi there folks, it's James Marlay here, co-founder at Livewire Markets, and welcome to this asset allocation panel discussion as part of our 2026 Outlook series. Now 2025 has been a good year for investors, but I reckon there's a few twists and turns that lie ahead in 2026. It's not all smooth sailing. I'm joined today by Charlie Viola from Viola Private Wealth and Ben Clark from TMS Private Wealth, and I'm going to be drawing on their decades of asset allocation experience and building portfolios that can compound over the long term to help set you up for 2026. So Ben and Charlie, thanks very much for coming in and great to have you back in.
Thanks, James. Much appreciated.
Good doing it. Yeah, good to see you, Charlie.
You too, mate.
So folks, in this session, we're going to discuss a few of the factors that are influencing their thinking around asset allocation. We'll talk about setting realistic return expectations, which I think is appropriate after a couple of bumpy years in markets. And we'll also do a little check-in on my SMSF portfolio, just to talk through some of the changes and bring you a real-world example of how these two gentlemen think. But to start off with, a quick run around the grounds on asset class returns. Global equities with the S&P 500 up 16%, Aussie equities mid-single digits, bit over 5%. Fixed income, this is using a US total bond market return, just under 7%. Gold, the standout, up 59%. Cash, you can get a term deposit around 4.35%. And Bitcoin, which was topping the tables last year, down 2%. Now, gents, when I revisited our session from last year, I think you guys get A+, full marks on some of the calls you made. So I'm imagining your clients have had a good year. The challenge now is to do it again. Charlie, let's start with you. What are the top two or three factors that are top of mind for you when you're thinking about asset allocation going into 2026?
Yeah, look, I think it's always the same, right? So for 25 years of counting other people's money and, trying to spread it around and have good asset quality and good diversity, it's always the same thing. So GDP growth around relative economies, inflation expectations, because it kind of drives interest rates, and then we like to look heavily at the general data. So, and that's really important to us. Earnings numbers, US job numbers, company earnings. And what we've probably all seen is that if we go back 2 weeks, NVIDIA were going to announce, we all basically held our breath for about 12 hours because we knew that if NVIDIA didn't hit their numbers, the whole market was going to fall off the back of it, hit its numbers, and we kind of continued on our merry way. So, we'll continue to look at those fundamentals. We always look for the signals rather than the noise as we build out those portfolios. And the proof is a little bit in the pudding. Last year we sort of talked about we wanted to hold a little bit less in terms of Australian equities, and it wasn't so much reducing the amount of Australian equities, it was not allocating more to Australian equities in the same proportion as what we had done previously. And the 5% outcomes versus where we did put a bit more of our allocation to global equities, which did a bit better than that, is probably proof in the pudding there, and a bit more to those sort of defensive and growth alternatives, which again have generated outsized returns versus equity returns over the past 12 months. So, and we'll keep doing the same thing.
Just on inflation, it's really topical here in Australia right now. What's your read on sort of the divergence with the inflation and the rates outlook here in Australia versus US, and how are you thinking about that for the year ahead?
Inflation in the US seems to have less of an impact because of, their loans are done over 30 years and therefore the sort of cost of capital issues are less than they are here. Our loans are done shorter. We have, the impact on spending is greater here. So we are way more focused on it here, and our credit markets and our banks and what have you are far more susceptible. And certainly our A-REITs, we've been open for a long time. We don't like investing in listed REITs. They're just way too susceptible to rate markets. I think the inflation story, inflation's kind of stagnated. Like it's been reasonably steady for a period of time.
Yeah.
What we need to see now is a whole cycle of that, and those rates remain reasonably steady just to give markets a good level of confidence. We do think that cost of capital is coming down, and should continue to come down over the next 12 months, and that augurs well for equity markets generally. Nothing is good when rates are high, right? So we want to see those rates continue to sort of be where they are and continue to subside over the next sort of 12 months. And that'll continue to give us confidence to invest in, equity markets and especially those kind of growth private markets. We're big ones for putting long-term capital into VC, PE, infrastructure, all which requires those rate cycles to remain reasonably stable.
Ben, I'll bring you in. two or three things that are front of mind at TMS Private Wealth when you're thinking about 2026?
Yeah, so I think for me, valuations is something. So if you go back to the start of this year the end of last year when we recorded this, I think we both sort of highlighted that the Australian market on a valuation basis had got very expensive. I was of the view that many of the stocks that we've held for years were trading on multiples I'd never seen them trade on before. So we had 25's been a bit of a weird year. You can sort of forget that we had this like really strong run in at the end of 2024, which was sort of unexplained and there was no real logic to. So if you fast forward to now, I'd say valuations in Australia aren't cheap, but they've got closer to their longer term averages. So I think one of the reasons the main reason in fact, I think our market's been, has underperformed the US. We can all talk about AI and big tech and that sort of stuff. It's more that the starting point valuations were really elevated. And now, like when I look at those same group of stocks, I'd sort of say they're trading on earnings multiples that we're pretty used to seeing, and they can diverge up and down. So I think going forward, we might get a better contribution out of Australia next financial year if this interest rate setting is under control. The second thing I'd say is like long-term bond yields, I think is something to keep your eye on. Australia's 10-year bond yield has nearly hit a 15-year high now. That's a bit of a worry that all asset prices ultimately are priced off long-term bond yields. Doesn't matter if it's infrastructure, property, shares, Bitcoin, whatever it is, gold. That is a headwind for markets at the moment. So we've gone just into this last month. It feels like markets, particularly locally, have readjusted to a different interest rate outlook, and hopefully that kind of calms now. Bond market's sort of happy where it is. The share market will take a breather and go back to focusing on earnings. And then I think on the alts part, the US has broken away from Australia. It's been a weird year where they're in a rate cutting cycle. We might have a rate hike next year. Let's hope not. I don't think we will. That augurs well for the alternative investments, particularly for the more global managers. Definitely seeing activity picking up. Secondary market trading's been quite strong going into the end of the year. The IPO market in America is open and in Europe. So that allows for these firms to monetize existing investments, hopefully at good levels versus valuations, and recycle capital. Yeah. So they're all sort of themes that I'm feeling like we're watching into the end of the year.
I think Ben's right. Those Australian equities, especially where you use them as sort of bond proxies, where you use them to generate and push cash into client bank accounts, it's much more palatable to do it when CBA is at 150 than 175. So there was probably some sensible pullback in the banks, and that's obviously impacted total returns for the 12-month period, just given how much they dominate the index. So we're still buyers of Australian equities. We just might do less of it than what we might have done 5 years ago, because the relative return for the risk you take now is a bit lower. They're still good things to buy. They still should be in all client portfolios.
Ben, just on the Australian market, for the index to move higher, you generally need the banks to make a decent contribution. Yeah. It seems like some of the steam that was in, full steam ahead this time last year has come out of that banking sector. Does it look more reasonable, or do you still feel like that's going to be an anchor on the market?
I still feel like it's going to be an anchor. I still think at best this year, 2026, bank share prices might be where they started the year and pay a reasonable dividend yield. I think they could come off a bit further. Their valuations are still stretched. Next year, to me, sets up as being a really interesting year for more active managers, because what has also decoupled is growth stocks in Australia versus growth stocks in America. If you look at the returns of a lot of growth managers for 2025, they've had a really rough year.
Domestic growth managers,
and also actually global growth managers in many cases have significantly underperformed the index. And so not all, but some. But locally, I'd say that it hasn't been an earnings issue that has seen this. I think that interest rate story locally has been a part of it. There's sort of the AI scare campaign with some growth stocks, but where valuations now are in that part of the market, look much more attractive than we've seen in a while.
Why don't we get into the practical side of things and bring up the allocations that you've sent through? These are hypotheticals, and the gentleman would tell you they would tailor these allocations based on individual client needs, but I think it gives you a good picture, and the charts that we'll bring up on the screen for you show target allocations, where they were this time last year and where they are today. Charlie, I'll start with you. Maybe you could talk through some of the major overweight, underweights, and how you've thought about putting this allocation together.
Yeah, so when I think about what we've done here, and I guess the questions were asked by you, is how would we invest kind of new money through the year, and how would we deal with existing portfolios? Ultimately, we're probably reasonably fortunate in our business. We take on a lot of new cash, new capital. We've got lots of investors who continue to work and bring us new money. So it's how we allocate new money that comes to us. So, as you can see from the chart, we had a lower weight over the last 12 months in terms of our domestic equities exposures. We still like domestic equities. It was still generating a reasonable return for the risk that we were taking, but we definitely favoured global equities, and investors have done well as a result of that. So that feels like a good decision. I think we, like everybody, have benefited from that sort of mega cap tech exposure that sits in these portfolios. I do think that if we're going to see disruption, it'll be in that AI space. So, that's something for us to be really cautious about and kind of make sure that we're continuing to review. One place where, what we're reasonably well known for and we do a lot of, we like to generate real revenue within our client portfolios. We've done that through private markets. We've probably got a bigger allocation to what we call defensive alternatives. Yep. So private debt, private credit, and real asset type stuff, so infrastructure. We like those in our portfolios. It punches cash into the bank account. Important to understand that we use it virtually as opposed to fixed interest. So private credit is a massive spectrum, all the way from very low LVR, first loss provision, no construction, all the way up to virtually pref equity, right? Yeah. We tend to use defensive alternatives all the way down the defensive end, where we've got security of our capital, again, good sponsor strength. And we know, generally speaking, the unit price isn't going to change from $1, but we keep punching money into the bank account. So, our target return out of that sector is sort of 6 to 9% for clients. And we like it because it gives us real cash flow into portfolios that allows us to redeploy over time. We put a bigger amount into the growth alternatives, so private equity, VC, some of the private credit stuff, which sits more at the equity, and infrastructure style investments in 25. We'll do the same in 26. We continue to think, if we're taking kind of 10, 15, 25-year view on portfolios, that's where the best returns are going to come from. We saw a good year for private equity managers, both as a result of the secondary stuff that Ben was talking about, but we're actually now starting to see exits occur. We had a period for probably 4 or 5 years where a lot of the managers were really struggling to kind of, they were kind of rebasing valuations, but they were struggling to get actual exits. We're now starting to see exits, clients getting their money back, confidence has kind of resumed, and we've had this significant, almost kind of democratization of these private equity markets. It's just much easier to access, even for a client, with a smaller balance. It used to be only for family offices and institutional investors. Now everybody can kind of invest in it. So we're really comfortable with this. We don't feel the need to hold heaps of cash. We'll find liquidity from other parts of the portfolio if we need it. And again, we benefit from people sticking new money in, and this is kind of how we'll allocate it.
Ben, let's jump across to what you sent through. We'll bring it up on the screen for our viewers there. Let's start on the home base.
Yes.
The original target was 50% Aussie equities.
Yeah.
This year down at 35, which is down from 40 prior year. So that's obviously a big tilt for you.
I think of 2023, first half of 2024 was us educating ourselves on this alt space. It had been a place that we hadn't played in, really, given our DNA as more direct investors. And what really interested us was that there was 2 or 3 really tough years in that private equity market due to what happened with rates and a dry up in exits, etc. And there was froth in public markets, and it was too big a disconnect. And so the reason we've came down very rapidly at the end of last year and further down this year is we've seen growth alternative options which we think look really interesting. And for up until probably June, sort of July, we saw very frothy valuations. So it wasn't that we've made a call that we don't like the Australian share market. It's more that we felt the time was right to go from an area that felt a bit overloved in the short term into an area that felt out of love. I guess deal flow is another thing. Sometimes you don't always you can't invest in these sort of funds under your own sort of time frame. There's kind of a set date where you need to be a part of it, or that's it. And there's been one that we've done this year that's fit into that box. So. But as I said, I'm probably more optimistic on the forward year than I have been for a while on the Aussie equity front. It's just been, and the growth alternatives. I mean, it's sort of been 14, 15 months, but they've significantly outperformed the Australian share market this year. So we're off to a good start. Global, look, it's not that we're adding to global. I think what we're doing is we're letting, we're not trimming it. I still think the setup for global looks pretty good. Feels like such a hated bull market in America, and it's been because it's been driven by such a small part of the market. But they're in a rate cutting environment, despite all the press write up about AI bubbles and all this kind of thing. Earnings momentum's been very strong in these big tech companies. It's not just a valuation uplift that we're seeing. It's being driven mainly by earnings. So we're happy to let that component of our portfolios continue to run and become a bigger part with the growth that they've experienced. Fixed income's been pretty static. So, for us, that's more securities that are listed on the bond market that we've gone into. We get securities rolling off, and I would say that credit spreads really tightened up through 2025. You're getting into August, September, and on investment grade paper, like 5-6 years to maturity, you're looking at sort of low fives that you're locking in. We just did a deal at 7, so which is investment grade, 5.5 years, looks really strong. So that's an area that we've probably just maintained our exposure to. We've had a couple of deals that we've done this year in the growth component of our portfolio, which is why that is lifted. And defensive, we've allocated to one new defensive manager, and we're still probably stage 2 is familiarising ourselves with that part. My take on it is all the press beat up about private credit, I think, has just got completely out of control versus the industry has actually performed very well, I think. And you read these front page articles about one problem loan in a $40 billion book, and it feels like there's a bit of, I don't know what you think, Charlie, but it feels like there's a bit of a scare campaign out there. I think the industry does over time need to continue to increase its transparency and sort of go the path that listed shares did many years ago, but that'll happen, and we're open to looking at it.
Manager selection in that space is actually really important.
Yeah.
So once was an investment banker, now as a private credit manager kind of thing. There are so many boutique private credit managers that, we would get 25 emails a week from somebody else sprouting a different loan book that they might have, or, private credit fund that they're trying to raise for. The manager selection stuff. So, that old saying that past returns is no indication of future returns is the biggest load of crap ever. Of course it is. We want to know what your process is. We want to know what your screens are. We want to know how you've performed when the debt has had to step into the shoes of the equity. So that manager selection stuff, and certainly where we invest, and where a business like TMS are going to invest, the reality is those managers are top shelf. And to Ben's point about markets over the next 12 months, whenever you have a rate cycle that's either steady or the cost of capital is going down, and you've got an earning environment where those earnings are really stable, it's good for investors, and that's what we're seeing now. And that's why you see, there's a fair bit of similarity between our asset allocation. We're happy to put people into things that go up and generate earnings over time. So
what a novel concept.
And that's how we generate returns. One of my least favoured sayings, or most hated sayings, is, I don't want to invest because markets are at all-time highs. Well, they actually have to be at highs for you to have made money.
Yeah.
Otherwise you've not made money. So that's not the determinant. The determinant is, what are the earnings doing and what do the fundamentals say? And we're actually in a pretty good space.
I think the other thing is, as an advisor, it's not just placing money in these funds, it's then continuing to monitor the funds, the people who are a part of the, if you saw people leave that were there when you first went in, that's a red flag. So it's not like the job's done once the money's gone in. And as Charlie was saying, like the liquidity options and the democratisation's got so much better. So you can make changes in this part of your portfolio.
Great. Well, folks, we're going to jump into a bit of an educational component of the chat. For those of you interested in learning more, if you revisit, and I'll put these links in the video and on the wire, on Livewire, the one from 12 months ago, we talked about portfolio rebalancing. I caught up with Ben mid-year to talk about in more depth about private markets. Today, return expectations. How do you set a reasonable return expectation? I think it's timely because people would be doing a few victory laps after the past few years. But if you haven't shot the lights out, you haven't done 15 or 16% or 20% or 25%, whatever it is, but you've done 10%, you might be feeling like you've got a bit of FOMO. So Ben, I'll give this one to you first. Yep. How do you talk to people about setting out a reasonable return expectation from their portfolio so they can be comfortable with something that doesn't hit the front page of the newspaper?
Yeah, look, I think so. I think a misconception about the industry is that we're always just trying to generate the best returns possible for a client, and that's definitely not our approach. So what we want to do is get to know the client financially pretty intimately and really understand what their objectives are for the rest of their lives and potentially multi-generational. And it's actually then looking at, okay, well, what returns do we need to generate to give the client those outcomes without taking on levels of risk that don't need to be taken on. So, for some clients, and then you've got to talk to clients about, the time frame that they're potentially going to be investing for. Everyone's got different tolerances of risk. Some clients have got very high tolerance of risk, others aren't quite so high. So my long answer to this is it's not a one bucket fits all, and that's where you should be wary. If someone's putting you in a bucket, it's probably not the right solution because everyone is wired differently and everyone's circumstances are different, so their portfolios should probably look differently. And so our view is, we're sort of backloading a portfolio based on what a client's objectives are. And that might mean that some of these different asset allocations actually have different weightings for different clients, and that is the case for us. So that's part one. The other thing I'd say, an often understood term is risk-adjusted returns. Everyone talks about returns, but how much risk were you taking on to generate that return? So the bond I was speaking to earlier, that's going to pay a 7% return each year for the next 5 years, and I really can't see a circumstance where that's not going to happen and the capital to be repaid at maturity. That's probably an okay year, not a great year, but it's an okay year in the Aussie market. But the Aussie market will have negative years along that path. So you've always got to be weighing up how much risk did I take on to generate those returns. And in years like we've just had, if you've done those 14s or 15s, you could find that next year you might do a minus 15. It's not inconceivable. Yep. And so you've got to keep them back in mind.
Yep. Charlie,
he stole all my material.
Well, I'm actually going to make you a bit of a hero here because I think there is a lot of industry style terminology that goes around. Risk-adjusted returns is one. Maybe give people who are watching this video a couple of practical questions that they can ask themselves. Like you would get, Ben talked about getting to know clients.
Yeah.
What are the important questions to ask?
Yeah. So we're exactly the same as Ben, right? We talk about being rewarded for the risk that you take. Taking risk is okay, as long as you're being rewarded for it. And seeking out big returns is also okay as long as you can handle the drawdown if it occurs. So we're also the exact same as Ben, where we talk about the context of what a client's trying to achieve. So if you're a client and you're sitting in front of your advisor and the advisor's talking to you about your risk profile or allocation of monies, you need to be really clear with your advisor in terms of what you're actually trying to achieve. You need to be saying to them, hey, I've got whatever the number is, I've got $5 million and I would really like to have $200,000 of free cash flow from that portfolio, and I would like to protect the buying power of my money over time. I would like to see that the 200 becomes 210, becomes 220, becomes 230, and I would like my $5 million to still kind of be there so I can leave a legacy over time. Can you build me a portfolio to do that? At that point, people like Ben and I would go away and we'd build a portfolio around, okay, we need to generate the revenue. So we need enough in the defensive alternatives, the infrastructure style assets to be able to do that. But we also need earnings growth. So we need to put enough into equities to generate some of that earnings growth, because we know good quality companies will grow their earnings over a period of time. So the portfolio construction will always, to use Ben's terms, be backfilled based on what the client is actually trying to achieve. I think as clients, as individuals, just be really clear. And as advisors, it's our job, because clients won't always know how to ask that question, to tease it out of the client, to make sure we're asking that question. The one bit where I differ just a tiny bit from Ben is that while we build all portfolios bespoke, and we do, and we build them in the context of a client situation, the reality is what you find over time is while everybody is different, everybody is a little bit the same. I've been doing this for probably 25 years, and what I've found is that everybody wants you to protect their capital, generate revenue through the cycle so they can buy bread, milk, rice, race cars, whatever it is that they do with their money, and they want growth. And they want growth in two ways. They want earnings growth so that you can protect the buying power, and you want capital growth so you can protect the legacy of the capital. So when we educate clients about what's feasible, unfortunately, we've had a period of 15 years where markets have done nothing but go up. We've had emergency low interest rates. We've had multiples blowing the roof off. We've had these mega cap tech companies where the subscription numbers have run significantly. So we've all become accustomed to returns of significant double digit. We try and educate clients that if we can generate 8 to 10 to 12% annually over the medium term, some years will be better and some years will be worse, they're good outcomes, especially where about half of that's going to be income and the other half is going to be capital growth. If we can do that consistently over a really long period of time, protect your capital, be well diversified, then the long-term application of the money will be really positive for every investor that we have.
Yeah. Okay.
One other tip I give, Jimmy, to viewers is one thing I've often found is potentially a husband and wife might think very differently about this, and it's having a conversation together about what we're trying to achieve with this money in tandem with seeing a financial advisor. If one were to pass on, is the portfolio appropriate for the potentially less risk averse partner, or vice versa? I think we both deal with generational money. There's a time also when you want to start to think, well, we've got more capital than we're ever going to need, and we're generating more income than we're going to need. How do we invest this for the next generation? And starting to talk to kids at the right point is a good thing to do as well.
The best education we think anyway, the best education we can provide is what is your money actually going to produce? What we do for every client every year is we actually give them a revenue schedule. So we give them a list of every asset that they've got and the level of revenue that's being produced by that asset. So they can very clearly see how much cash is expected to be generated over the next 12 months. And that helps them formulate a view on whether they're comfortable with the cash being generated or not comfortable, or they want to take more risk to generate more cash, or they've got more need for capital through the year because they're expecting to go and sail down the Rhine or buy the McLaren or do whatever it is that they're doing with their capital. Our best way to describe to a client or educate them around how their portfolio will perform is tell them to treat it like a business. At the beginning of the year, you'd work out, who your clients are and how you're going to generate revenue. We do that with every asset. And it's a simpler saying. If we hold 1,000 CBA shares and we know that CBA are going to pay a $4 dividend, we know we're getting $4,000. Yep. If we've got $100,000 in a property syndicate paying a coupon of 7%, we know we're getting $7,000, and so on and so forth. So we can show the client, we expect 250 grand to turn up in your bank account over the next 12 months. Is that enough? Does that satisfy your needs, or are you comfortable with that? Because we have to take a requisite risk to be able to produce that. Yeah, if that makes sense.
Yeah, very good. Change of tack. Let's talk about protecting capital. Is there an asset class or investment you think investors should be cautious of and steering clear of? What makes you nervous as we look at 2026?
I think the safe havens, gold and Bitcoin, is what I would single out. I know gold's had a stonking run, best performing asset class last year. I just, when you're seeing these photos of queues of people in Martin Place wanting to buy gold, it's classic top of the market stuff. And I've noticed those queues have started to die down every time I walk through Martin Place. I don't think gold's going to significantly drop off. I'm just saying I don't think it will be the best performing asset class this calendar year.
So last year we agitated the Bitcoin supporters on the video because it didn't get a call out. You've now guaranteed that we're going to agitate the people that like gold, Ben. Thanks for that.
The gold bugs.
Spend all of January responding
bugs.
to comments on the YouTube channel.
Bitcoin's certainly not a safe haven. It just acts like a risk asset.
Well, the way that those two have decoupled is quite interesting.
Yeah, it's just a risk. Like it just correlates to risk assets and almost magnifies what risk assets do. Risk assets go up, it goes up harder, and when they sort of start to pull back, it goes down a little bit harder.
Charlie, same question for you.
But just a tiny bit cautious around those assets that are really heavily kind of embedded with AI, because I think that's the one where disruption will happen reasonably swiftly. We're still reasonably comfortable with those tech companies given where earnings are, etc. But any major US company that misses its earnings because of our now expectations of those earnings is going to get smashed. Yeah. And I think that's just going to have a bit of contagion risk to it. So I think, I think the volatility, if that occurs, we're going to have a bit more volatility. I actually think we'll see those things snap back, but expect volatility if anyone comes out with anything soft in their language, because we just now expect all CEOs and CFOs to come out and sing from the rooftop and tell everyone how good they are. The minute they come out and say, hey, trading conditions might be a little bit softer, or we're going to see a slowdown in subscription numbers, or we're going to make a few less GPUs this year, I think markets will take a fairly heavy breath at that point. Yeah.
Alrighty, very good. Well, folks, this is the part where I get a bit nervous, get a few chills. I'll bring up my own personal SMSF. The idea here is definitely not to give you recommendations, but it's hopefully to bring some of the things we've discussed into a more practical light. I've shared this over the past 2 episodes I've done in this series, and I thought I'd just take you through some of the changes that I've made. I have reduced and completely sold out of direct equities in BHP, CSL in June, and I exited Charter Hall in November. I have reduced throughout the year at different points my position in gold, ResMed. I reduced the size of the holdings in the global growth funds, and also the illiquid emerging companies, just trim that down. They're all still in there. Originally, the intention, as I said to you gentlemen before the show, was to look at introducing some alternatives to the portfolio. I still haven't quite got my head around how I want to do that. Pretty busy with young kids and work, and I took the easy option, which was to pay down the mortgage on the commercial property that Superfund owns. So yeah, that's where it sits today. It's done about 16% over the past 12 months, plus paid out that income. Although I must say, I still feel like I'm sitting a little heavily on the growth side of the boat. Although I would call out that the biggest single exposure is a highly diversified global ETF. So yeah, that's what it's been doing. Any pro tips?
No, I mean the real return that you get out of paying down the debt is like 6 or 6.5%. So it's a good balancing act in terms of doing that. The fact that you trim back those things that had run really hard is sensible from a risk management point of view. So well done. I maintain that if we were putting this portfolio together, we would end up with a graph that kind of had 2 really big blocks. In terms of that sort of equity risk that you take in the portfolio. You've been rewarded for that. We talked before about getting rewarded for the risk that you're taking. You are taking a huge amount of equity market risk within this portfolio. You've been rewarded for it. The way to make sure that you sustain good returns over time is now diversity. So we think that it's probably time to add a little bit of private equity style investment, some real asset exposure in infrastructure, which will just generate that kind of recurring revenue. And then just as you sort of your exposure to the S&P Global 100, so IOO, I assume that you're holding there, that's a really good quality, broad-based exposure. Leave that, add to it, get some dollar cost averaging benefit from it over time. Just do some filling in of the other bits of the pie, because you've kind of got 2 big slices and not much of the other stuff. Just fill those in over time, my view.
I'd agree with all that. Although I would say you've got 20 years on your side, Jimmy. So, there'll be drawdowns in equity markets. There'll be multiple drawdowns over that time. But, if you were probably sort of eyeing 5 years away from needing to start generating a revenue stream from this, you'd be restructuring faster. So I agree with everything Charlie said there. I just maybe call out in the Aussie equity component, a lot of exposure to one manager. Great manager, so it's not a criticism of the manager, and I know the guys well. They're really good managers, but maybe it's diversifying that a bit. And I'd say at the moment, with the sell-off that we've had in growth on the Aussie market, maybe there's an opportunity there to pull a bit of money out of the small caps and go into an unloved part and just diversify manager selection. So that would be my only thing I could add, apart from over time building in some PE. But as I said, you're young, sprightly age, you're younger than me, so
well, maybe
got time.
I was going to say 20 years, he's got you retiring at what, 78?
maybe I'll make that
I'd probably take a bit more of your winnings out of gold if I was honest. I think that's kind of where it's at now, and I'd be taking those winnings, and because I think the same time frames, those 20 or 25 years, PE will produce the best returns over that time just by the nature of the asset class and the types of companies. I'd take the winnings, apply it to your time frame, which is really long, and stick that into good quality private equity managers who are proven to do a really good job, and kind of close your eyes to the short-term movements, because who cares? We care about those long-term outcomes.
So that's going to be my New Year's resolution, is to be sitting here in 12 months' time and to be able to show you guys that I did the diversification piece. But as always, thank you both for coming in. Appreciate all the time that you put into preparing and being so open with how you're thinking about markets and how you're investing across your client portfolios.
Thanks, Jimmy.
Thanks for having us, mate.
Ladies and gentlemen, I hope you enjoyed that follow-on chat with Ben Clark from TMS Private Wealth and Charlie Viola from Viola Private Wealth. I'll put the links to prior episodes in the comments. I think they're worth revisiting. There's plenty of asset allocation tips in there. And remember, keep an eye on our Outlook series. We've got a whole bunch of awesome content dropping throughout December and January. Have a great year.